So the last few slides explain our first rule for the operating activities section for the indirect method, which was adding depreciation back to net income. The next rule is going to explain why gains and losses on the sale of plant assets are removed from the operating section. Why? Because the total cash from the transaction must be shown in the investing section, not the operating section. So we're going to run through an example, and this example will have a gain, but will not have a cash portion of the transaction. So that's what's going to be different about this example from the one we previously had in this PowerPoint. So let's review the sale or a gain or loss on the sale of a non-current asset. So the rule is if a non-current asset like your truck, your equipment, your building is sold or exchanged, the resulting cash flow, if there is any, goes in the investing section. Why does it go in the investing section? Because changes to long-term assets goes into the investing section. And the gain or loss is backed out of the operating section because gains and losses are included in net income, but the cash impact of the sale does not belong in the operating section because the operating section is reserved for day-to-day operations. Selling assets is not part of day-to-day operations. Selling inventory is, but we're now talking about selling long-term assets. So the next few slides are going to demonstrate why this is true. So now it's important to note we are now only talking about the gain or loss and why it is added or subtracted from the operating section. If cash was received, the total cash amount appears in the investing section. Even if cash is received, the gain or loss still needs to be subtracted or added to the operating section, and I'm going to show you exactly why. So before we can create our statement of cash flows, we need to create an income statement. And to keep this simple, I'm going to do an exchange of a long-term asset that's going to result in a gain or loss, and then we'll do one revenue transaction. And then from that, we're going to create a simple income statement and then the statement of cash flows. So here's our scenario. On our books, we have a truck that costs us $10,000 and it's being sold. The truck has accumulated depreciation over the years of $4,000. So what's the book value? In other words, what's the value on our books of this truck? Well, the book value is the cost, $10,000 minus the $4,000. So on our books, the truck has a book value of $6,000. So here's the transaction. On February 2nd, Mary's company exchanges the truck, the one that costs us 10 grand and has $4,000 of accumulated depreciation, for equipment valued at $5,000. So let's think about that for a minute. We're going to get equipment that's valued at $5,000 and we're giving up something that's valued at $6,000. So do we have a gain or loss? Obviously, we have a $1,000 loss. But let's journalize this transaction one step at a time. So it's February 2nd. And our new equipment is going up. So that is the debit account. So we're going to post it in our T account first, just for learning purposes. So equipment is going to be debited for its value on February 2nd. And now we have to get rid of the truck and the accumulated depreciation from our account. Which one will we get rid of first? Well, we have to do debits first. So we need to debit the accumulated depreciation account to zero it out. So I'm going to zero out my T account, and then I need to record that in the journal entry. And now we need to get rid of the truck account. So how do I get rid of the truck account that has a $10,000 debit balance? Well, you need to credit it, so it has a balance of 0. And now I'm going to put that in the journal. And I skipped a line so we can show our gain or loss. So let's just look at this number-wise. What is the balancing amount? What's the difference that's going to balance this account, this transaction? Well, we need $1,000 on the left side. And is that a gain or a loss? Well, we already said we're giving up a truck worth $6,000. We're getting equipment worth $5,000, so we have a loss. The other reason you know that this is a loss is because the $1,000 was a debit. Losses have a debit balance, just like expenses. If it was a gain, it would have had to have been over here on the credit side. And remember, gains are like revenues. They both have a normal balance on the credit side. Now, we need one more transaction, then we can create our income statement, and then from that, we can create our statement of cash flows. So it's the end of the month. Mary's company mows Safeco Field for $3,000 cash. So we need to journalize the transaction. So it's February 28. Cash is going up, so that is the debit account. And we have a revenue account. So let's call that mowing revenue. Now we have two simple transactions from which we're going to create the income statement and then the statement of cash flows. So the same transactions are now down here in the lower left part of the screen. And let's create a simple income statement for February. So this is Mary's mowing service, and the income statement is for only the month of February, those two transactions. So we need to do our revenues. So let's look down here in the journal entry. Do we have any revenues? Right down here at the bottom, we have $3,000 of mowing revenue. And now we need expenses or losses. Remember, losses go in the expense section of a income statement. And we look down here, we have a $1,000 loss on the sale of that truck. So what's our net income? Well, revenue minus those expenses gives us a net income of $2,000. So now that we have the net income, we can start creating our statement of cash flows. So here is the format for our statement of cash flows. And what's the first section called? Cash flow from operating activities. And what does the operating activities category always start with? Net income. So how much is our net income? $2,000. And why do we start with net income? Because net income will be approximately the same amount as our cash flows from operating activities. Pretty close, but not exact. And the next section from your book is called Adjustments to Reconcile Net Income to Net Cash Provided by Operating Activities. You don't need to memorize that. So let's figure out what to do with the loss for now. Let's simply go down here to our journal, our whopping 2 transactions, and let's see if we can figure out what the cash flow is. Now, I told you earlier that companies can't do this. You can't just go through the journal entries and look for cash transactions because it's going to take too long. But since we only have 2 transactions, yes, we do have time to do that. So the only cash flow transaction here is $3,000, and it's positive cash flow. So cash flow from operating, and I should say this cash flow, $3,000, came from selling. And so that does belong in the operating activities section. Remember, buying and selling activities goes into or I should say cash flows from buying and selling activities. In other words, revenues and expenses do go in the operating section. So we're going to plug that in here. And we know we have net cash provided by operating activities, a positive $3,000. Why? Because that's the only cash transaction that occurred during the month. So now let's figure out what to do with that loss. So what must we do to the loss to go from a $2,000 net income to $3,000 cash flow? We need to reverse or back out the loss. And how do you back out or remove a loss? Remember, a loss was subtracted, so we have to add that back in. So that's why this $1,000 is a positive number here. So why is a loss on the sale of an asset added back to net income when calculating cash flow? Well, in this case, exchanging the asset did not affect cash, but the loss did lower net income, as you can see over here in the income statement. Cash did not change hands in the equipment for truck exchange. So we need to remove the loss by adding it back to net income. Now, if this transaction also resulted in cash flow, then the cash flow would go in the investing section of the statement of cash flows, because the investing section has or contains changes to long-term assets. So now what we're going to do is we're going to do Tiny Tim's towing service. We're going to do an income, or from an income statement, we're going to create their statement of cash flows. So here on the right side of the screen, we got Tiny Tim's towing service, income statement. We got $1,000 of towing revenue. We have a $700 loss on the sale of a tow truck. So our net income is $300. So now we're going to use that to create the statement of cash flows, at least the operating section. So we always start with net income. So we're going to bring over the net income from the income statement. And now what are we going to do with this loss? Well, we have to remove that loss. That's our new rule. So how do you remove a loss? Well, remember, the loss subtracted from our revenue, so we have to add it back in. So their net cash provided by operating activities for Tiny Tim's towing service is $1,000. So that is the explanation for why gains are subtracted and losses are added from the operating section.